Hi everyone, my name's Darryl Panes, CEO of As Good as Gold Australia, and today once again I'm joined by my brother Brian and partner at As Good as Gold, and today we're privileged to interview a very special returning guest. He is an icon in the financial and precious metals space. We speak of none other, of course, than Bill Holter from jsmindset.com. Good morning, Bill.
Good evening to you too.
Yeah, good morning, Bill.
Bill, it has been a little while since we spoke last. We were just trying to work it out briefly before the interview, but I can say a lot has happened. I'm sure we'd all agree upon that. A lot's happened since we spoke last. In fact, a lot's happened since yesterday. That's how the world is functioning at the moment, isn't it? I mean, one doesn't know from one day to the next what's happening. There's policy changes taking place by the minute. Yesterday, a bloodbath, Bill, on the ASX, lost 2%. It's a big down here in Australia. The Dow, of course, down another 800 points overnight, following a similar experience going back a couple of days ago.
Yeah, 1,000 points.
Down 1,000 points. A lot of this has been brought about, these two downturns, by China's COVID crisis. They're looking at a major lockdown again. So this is sending companies into free fall in China. The markets have reacted, of course. Beijing, it seems, could go into a full lockdown, similar to that which they're experiencing in Shanghai. I mean, this would have a massive impact on global trade. And as if it needs that, of course. But it's almost impossible, Bill, to imagine that politicians, in this case in China, could make such poorly executed decisions. I mean, right now, this could have just a catastrophic impact on global markets. It's almost, dare I say it, as if it's by design. Your thoughts on that?
Yeah, that was my thought while you were saying that. Is it by design? Is it the plan? Obviously, what's going on right now with them shutting down their manufacturing, their exports, it's obviously going to be a big hiccup in the supply chain, and we'll feel that in 2 weeks, a month, 2 or 3 months, who knows? But we're definitely going to feel it. The world will feel it. And my thought process while you were speaking was that I believe it is probably planned. And what better way to collapse the Western debt edifice, if you will, than to throw a monkey wrench into the supply chain. At the same time, interest rates have been rising. Interest rates have risen dramatically over the last 3 to 6 months. I mean, we've actually gone on a 10-year treasury bond from 2 years ago, or a little bit less than 2 years ago, was 0.38 of 1%. And we actually got into the 2.9s yesterday and Friday. So we're pushing 3%. I mean, it is a absolute huge move. And if you look at the global bond index, that's now down somewhere in the neighborhood of $6 to $7 trillion. And understand that the credit markets are now the foundation to the financial world, the financial markets. When money was real years and years ago, money was real. At this point, the foundation is made out of debt. And the old saying, promises are made to be broken. That's what debt is. Debt is a promise. So you've got the China lockdown, you've got interest rates going higher, and of course you have the Russian Ukraine conflict. And what is that doing to trade? I mean, ask someone in Poland what that's doing to trade. They're worried about having their gas shut off tomorrow night. what's happening in Brazil. They have 27 tankers with fertilizer coming from Russia on the way to Brazil, and it looks like the World Trade Organization may somehow, some way say that those can't land. So it's pretty dire in pretty much each direction that you look.
I just really can't believe what's happening. I think what's happened, in fact, I know what's happened, is that people just place too much trust in politicians. Bill, we keep on hearing from our Prime Minister that the economy is in good shape. Can you believe that?
No.
That nobody else could have navigated the last 2 years as effectively as Scott Morrison and the Liberal Party here in Australia. Of course, they've got all the excuses in the world, as they always have: bushfires, floods, pandemics, and now, of course, as you mentioned, the war in Ukraine, and yet they still prevail. As I said, they just but they've got all these excuses that they refer to all the time. But hey, everything's still fine. They talk about unemployment levels being the best they've been for 40 years. They talk about apprenticeships being at a higher level than they have been since 1963. I look at this. I started an apprenticeship in 1968, Bill. I started with 105 other young men with a company, Holden's. Did an apprenticeship as a fitter and turner, and they had a specific training centre set aside for apprentices. They had done that in previous years, and they kept that movement going. Chrysler, who were also here in Australia, same thing. Australian Railways, exactly the same thing. All the white goods industry was flourishing at the time. Do you know, none of those industries and none of those companies operate in Australia today. They provide no apprenticeships today, where there were thousands of them before. So I don't know where these new apprenticeships are coming from. I just don't know. But what I do know is this, that the government here at the moment, and this is something that isn't mentioned, but the government provides $7,000 a quarter, $28,000 a year, that would be my reckoning, for companies to employ apprentices. Now, I don't know how much GDP is being produced by these apprentices in these new areas, but it's at an enormous cost to our economy, which is something that is not mentioned. So our debt levels continue to spiral out of control. The other thing that was not mentioned was that 1963, Bill, our Australia's population was just over 10 million, and today it's over 26 million. So everything else being equal, you'd want to have more apprentices operating at the moment, wouldn't you? So the point I'm leading to here is this. And Egon von Grey has said this very well. He said, Darryl, you can't trust politicians. All politicians lie all of the time. And that's exactly what they're doing now on a massive global scale. My point to you is, I'd like to ask this question: what does it need before people wake up? What does it need before the populace at large wake up to the fact that they are being told lies? We've just got to get on with it, recognise that. If we want to maintain our freedom, then we've got some work to do. What's it going to take, Bill, before people pick up on this?
That's an extremely easy question to answer. This has been financially engineered. How is it possible that global economies, global trade, and when I say economies and trade, I'm talking about the real economies. How is it possible? And take the auto industry, for example. in the US, it's very difficult to get new cars because they're not making nearly as many new cars as they had in the past because they can't get chips, they can't get parts. But no one cares about the real economy because all they do is they look at their 401k statements, they look at their brokerage statements, they look at the value of their real estate. So this has been financially engineered, and there were bubbles all over the world in equity markets, in real estate markets, and people are complacent, if you will. It's not affecting what's going on is not affecting them because they feel wealthy. So the answer to your question is when stock markets finally turn down, and they are turning down across the world now, once you get some waterfall action in equity markets, then the game's over. And that waterfall action has already happened worldwide in credit markets. And the old saying goes, credit markets are always smarter, more intelligent than equity markets. They always move before the equity markets figure it out. The bond markets worldwide, because interest rates are going up. I mean, look at Japan. They actually have positive interest rates now for the first time in 10 years or maybe more. So the credit markets have already weakened. They're cracking. Everybody knows interest rates are going up, but they don't feel the interest rates going up yet because the average person is not invested in bonds. They may have bond funds, they may have pensions, but they don't realize it yet. But just for example, in the US, interest rates on a 30-year mortgage just 6 or 8 months ago were as low as 2.75%. Now we're at 5.3, 5.4%. So what that does is it lowers the amount of potential buyers. And the reason being, if you qualified for, say, $1 million mortgage 6 months ago, you probably only qualify for a $600,000 mortgage now. Yeah. So that's a direct effect on potential buyers. And any Ponzi scheme, which is what this entire global financial market is, any Ponzi scheme has to have new investors consistently. And now all of a sudden in real estate, the new investors have been cut off at the knees and only have maybe 60% of the buying power that they had 6 or 8 months ago. And the other thing is, think about it in the past, and I'm sure you've known people who got into financial trouble but had equity in their property and they were able to refinance.
Sure.
These higher interest rates make it prohibitive to refinance. So the interest rates are definitely affecting real estate. We just had the amount of real estate closings were announced earlier today for March in the US, and they were drastically down from over the past few months. So the higher interest rates are starting to bite. And if you go back to 1982, when interest rates peaked, each time the Fed tried to tighten, they would break something. They broke the stock market in 1987. The dot-com bubble blew in 2000. The great financial crisis in 2007, 2008. Again, in 2018, they tried to raise rates. Every time the central banks try to raise rates, something breaks. And here we are now. We're actually back to, if you look at the, I think it's the 2-year Treasury. The 2-year Treasury now is approaching that 3% level, which is where they peaked out in the Fed tightening in 2008 and where they peaked out again in 2018. The only problem is there's much, much more debt in the system now than there was back then. So I'm thinking that 3%, this area of 275 to 3% is the demarcation line where if we blow through this, you're going to see all sorts of things break. And we did find out Wall Street on parade yesterday put an article out and they reported on the amount of derivatives outstanding. I think it was the top 5 banks are saddled, or I shouldn't say saddled, but it will probably turn out to be that. But they are counterparty to something like $274 trillion of derivatives. And remember, every derivative, when it's originally written, has an interest rate assumption. And now we're getting close to the point where interest rates are going to be higher now than they've been in the last 14, 15 years.
Yeah. Yeah. I know they're talking interest rates over here at the moment. This morning they were talking about 4% interest rates within the next couple of months. So it's... I
would say, Bill, that the United States is about 3 months ahead of Australia when it comes to making all these financial decisions. And the couple of questions that I'll have for you is, we're talking about it right now. What happens in the United States is going to happen over here in a very, very short period of time.
Well, the US sneezes, we catch a cold. We've always said that, haven't we?
Yeah, that's right. We certainly do. Bill, we've just touched on the subject of Russia. My question here is, worldwide there's been talk of Russia going back to a gold standard. And at this stage, I think that's a little way off. But we hear that Russia will only sell its raw materials and exports for payment in either rubles or gold. Bill, would you like to comment on this change of events, seeing that the Russian ruble has strengthened to 74 rubles to the US dollar, whereas it was sitting at 82 rubles to the US dollar only 2 weeks ago? Your comments?
Well, yeah, I'm glad you brought that up because it's a huge event. In my opinion, Russia demanding rubles or gold for their raw materials is the biggest financial news, the biggest monetary news since 1973. 1973 is when Kissinger came up with the Petro Dollar, where Saudi Arabia and the Arabs pledged to only accept dollars for oil. And that's what created the Petro Dollar. And then, of course, 2 years before that was when the U.S. went off the gold standard and refused and basically defaulted and refused foreign nations turning their dollars, their $35 in to get 1 ounce of U.S. gold. So, yeah, I mean, it's huge news. And think about it. Now Russia and China are doing business strictly in rubles and yuan. You've got other countries that are agreeing to do it. You have, for instance, the Israelis. What did they just do? I think it was last Thursday or Friday. They announced that they have liquidated a good portion of their dollars, a good portion of their euros. And what did they replace it with? Yuan. So what's happening is the dollar is making up less and less of central bank reserves. It's becoming used less and less for trade. So there's less demand for dollars at a time that the U.S. is exploding with deficits. How are those deficits going to be funded? And the answer is simple: the Federal Reserve. It is outright direct monetization. So, yeah, it's what's going on. I mean, Russia is, and I think, let me just mention this. I think everyone listening to this, if they can get a hold of Vladimir Putin's speech prior to the operation, that speech, read it through. It'll take you 10 or 15 minutes. It's fairly long, but read it through and see if there's anything in that you disagree with. Basically, what he was calling for was fairness in trade. And in other words, what he was saying is, we want something real for something real. We don't want to be paid with paper that's fake when we're giving you something real. So this is this is like I said, I think it's the biggest event since 1973, and that's what 49 years ago. I think it's huge. I think the monetary system, which was 100% dollar centric for decades, we are now moving into a bifurcated or even multi currency system, which does not have, will no longer have the dollar at the very center.
Yeah. Well,
Yeah.
I concur with you, and I'm glad you brought the subject up of that speech, because I haven't heard the speech, but what I did assume from Putin, President Putin, making the decision that he's made, is very similar to if you're providing your natural resources of a country. So we're in Australia and we're providing our natural resources. Most of those natural resources, special minerals, especially minerals in the ground, you can't replace. Once you dig them up, that's it. That's finished. You got to find some more. If you're supplying lumber, that takes 30 years to replace. If you're supplying grains and food, that can be done every year, but you only got to have a flood or a bushfire to wipe them out. So at the end of the day,
had all of those.
We have all of those. At the end of the day, we get supply.
Or currency collapse.
Yeah.
Or currency, and that currency collapses, and you lose that purchasing power. What are you going to use for fertilizer the next year? What are you going to use to pay for seed, et cetera, et cetera? Yeah. So there's all kinds of things that can happen with grains, but you're absolutely right. The game of something for nothing is ending.
It has to be that way. You cannot print your way into an economy, into a thriving economy. It's got to be done with real assets. We'll move on. Bill, the latest information that we are hearing in Australia is that the Federal Reserve is going to hike interest rates somewhere between 6 to 9 times by mid-2023. Now, I must say that Einstein said that the definition of insanity was trying the same thing over and over again, expecting different results. Using the last 10 years of history, I don't think they will get past 3 rate increases before the market crashes. What's your thoughts, Bill?
That was my number exactly. I'm pretty much on the record saying I don't believe that they can do more than 3 hikes. And those 3 hikes, even maybe one of them is 50 basis points. So that I don't believe they can hike rates more than 1% before they blow things up. And again, there's just so much more debt in the system today that precludes them from actually raising rates. Because like I said earlier, every time central banks raise rates, they've blown something up. And let's look at, on a side note, let's look at the U.S. debt. Look at the U.S. deficit. The amount of interest expense that the U.S. paid for years and years and years, probably over 30 years, was in the neighborhood of $350 to $400 billion. And it didn't move. It didn't go up. It moved about $100 billion range. The thing is, the total debt year after year went up because we've run a deficit every single year, but that occurred as interest rates were going down. But rates got to 0, and they can't go any lower than 0. So basically, their interest expense rate was probably in the 2 to 3% range. Now we're up to 650, 700 billion in interest. And if you take a $30 trillion debt and just use 3.3% as the interest rate, now you're talking about $1 trillion a year just in interest. Yeah. So that's the reason that you cannot raise interest rates on a debt-laden, debt-ridden system, because it has to be serviced every year. And where's that debt service going to come from? It'll get to the point where just to pay interest, they'll have to borrow more money.
Yeah.
And obviously, if the Fed outright continues to monetize, that just will dilute the value of the currency.
Yeah. That's probably why fiat currencies, Darryl, just don't last any more than an average 40 years. for the last 5,000 years.
Yep.
You know, no country that has ever gone ahead with a fiat currency has a successful ratio or successful rate. It always go to zero. Just to finish off here, Bill, I hadn't written this one down. I thought of it last night, so I just had a quick write down this morning. A question about the stock market and gold. I am going to ask a question. This has bugged me for a considerable amount of time. We use the expression "bug me." It's an expression to say I can't figure this one out. All right? An investor in the stock market.
I understand it.
Yeah. An investor in the stock market will sell gold when things get a bit shaky. Why is cash looked at a safer investment when in 1980 America's debt was 8.8 of a trillion, and today, 40 years later, it's 30 trillion? Why do they sell? Why do they go into cash? I'd rather go into gold. At least it's running at somewhere between 10 and 20% in improving in its cost as far as cash is concerned.
Yep.
So why do they sell gold, Bill?
Well, I don't believe they do sell gold. I think
Maybe the paper contract.
I think what you're seeing, exactly. They're not selling real gold. They're not selling physical gold. And I think you can probably attest to this also. I mean, I see this as a broker through Miles Franklin. We've had almost zero sales. They're all purchases by clients, new clients. It's not people selling gold. And I think you're probably seeing the same thing.
Yeah.
And you're certainly not seeing institutional sales of gold, because if you try to purchase 25 million, 50 million, even, small institutional purchases, it's quite difficult. I mean, the anecdotal evidence out of London, out of Switzerland, large purchases are difficult to make. And if there was actual selling of gold, it wouldn't be that way. What's being sold, and when I say, let me use sold in two different ways. When I'm talking about sold, I'm talking about the actual selling of it, but it's a story, it's a narrative that is being sold by the financial wizards of the world, that people are selling gold. That is a narrative. What's being sold are paper contracts to push the exchange price of gold, exchange price of silver down. This goes back to the 1990s with Robert Rubin's strong dollar policy, and they were leasing out gold. And there you had physical gold that was leased out. That would be sold into the market, and that cash would then be reinvested into bonds. And it was pretty much a no-brainer. You could borrow gold at 2%, and you could get 6 or 7% on treasuries. But that was actual supply into the marketplace. The actual supply in the marketplace, it's not coming. It is certainly not coming from leasing. It's certainly not coming from people thinking, "Oh my gosh, the stock market's down. I better sell my gold." That's idiotic.
Yep. No, that makes sense. All right, Darryl, I think you've got a question or two there.
Yeah, well, I do. We're just talking about gold, which is rare, of course, for us to do that. But I'm just wondering, Bill, if you could answer a question from, we haven't done this on a regular basis, but a lot of our subscribers keep asking us if we could answer some questions while we're doing these interviews, and I think they'd get a considerable thrill if we could ask a couple now and have your response to them. There's a young lady by the name of Genevieve Koning who wrote to us, and she was talking about, or she was interested in platinum and palladium, but she said that, or asked the question, how do they compare as an investment compared to gold and silver? Would you just like to respond to that and give your reasons as to why they would be a good investment, or how they compare to gold and silver?
Obviously, they're metals. They're somewhat rare. They're not monetary metals. They're industrial metals. Primarily, you've got palladium and platinum are used for catalytic converters, other industrial uses. So for me, I'd rather stick to gold and silver. They have monetary history. Palladium and platinum do not.
Yeah. No, look, I agree wholeheartedly, and it's pretty much the same answer that I provide on a regular basis. So we're
sometimes when coming from another person, people listen to that third person.
Absolutely. One other question from Quant 2011, and they've said here that gold and silver, they see it as a mobile investment, while real estate isn't. So so real estate is tied to particular location, political climate, state, whereas metals are not. But they've asked the question then and said, what other mobile investments are there? Like, is art a mobile investment? What else? How else, or what else would you categorize in similarly to gold and silver in that regard?
There is nothing. I mean, when you use art, art is subjective. It's in the eye of the beholder. It's not liquid. Gold and silver are understood, known, and will be accepted anywhere in the world. If you have a piece of art that you paid, pick a number, $5 million for a painting, in bad times, are you going to be able to find someone that will pay you a fair amount?
Good point. Yeah.
Whereas gold and silver are universally accepted all over the world, and you could go anywhere in the world with it and use it, spend it, turn it into the local currency, what have you. As for real estate, there's not even a comparison between gold, silver, and real estate. And the reason being, real estate is highly leveraged. If you go back 60, 70, 80 years ago, that wasn't the case. Much of the real estate was owned outright. Today, that's not the case. Most real estate has debt against it. And I've had people ask me or tell me, I'm going to purchase real estate. I'm going to buy it outright with cash, so I don't ever have to worry. Well, there are two worries. One is it can be taxed away from you. That's the first thing. And the second thing, who's going to buy your real estate if credit gets shut off? If there's a credit hiccup, shutdown, what have you, who's going to be the buyer of it? Whereas gold and silver are monies themselves. So putting cash into real estate, it's almost like, think about these NFTs, these non-fungible tokens. And price-wise, they're crashing now because they were digital air in the first place. But it's the same thing with real estate. Once you have some type of a credit event, which makes it more difficult for purchasers to purchase, it becomes self-fulfilling, where you have a neighbor down the street trying to sell his house for $300,000. Your house is the same size, but you really need to get out. So now you're selling it for $290,000. And then another neighbor's selling it for $275,000. So just because you bought a piece of real estate with cash doesn't mean that it's any safer, other than the fact that it can't be taken away from you for non-payment, except for non-payment of taxes.
Yeah. Good, strong points. Yeah. I think that Quant 2011 will be very happy with that.
Happy to hear that one.
Just continuing on with gold for a moment, your partner Jim Sinclair refers, of course, to becoming your own central bank. I think more than ever before, Jim Sinclair is correct with that statement. In fact, Brian and I have been following his lead for 30 years. We have become our own central banks. But what I'd like you to do, if you could, thanks Bill, is just explain to our viewers what Jim really meant by that. becoming your own central bank, owning gold?
Well, the central thesis is get out of the system. You don't want to be reliant on someone else's promise for your well-being. And if you hold gold, if you have it buried in your backyard or hidden somewhere, but it's in hand, think about this if you were a Canadian. And let's go back 2 months ago during the trucker convoy, and you gave $20 to the trucker convoy. You had your bank account shut off. So if you had your bank account shut off, what happens? It means you can't pay your rent or your mortgage. You can't buy gas for your car. You can't make your car payment. You can't buy food. You can't do anything because your funds are frozen, which of course is what they're trying or have tried to do with Russia with the SWIFT system. And that's backfired now because it's basically outright theft of goods by the world's, by the central bank of the world, if you will. The whole idea is with gold in hand, they can't shut you off because it doesn't have a title. You can sell it to another individual. You can sell it through broker dealers. You can sell it through pawn shops. And believe it or not, the only two assets that you'll get a fair bid out of a pawn shop is gold or silver. And the reason being, they'll take it from you and they'll turn around and sell it and make a 2, 3, 4% profit immediately and be done with it. Whereas if you bring in a chainsaw or lawnmower or whatever you bring into them, they're only going to offer you half because they don't know how long it's going to take them to sell it. So they give you a terrible bid. But gold and silver are that liquid that you're going to, even through a pawn shop, you're going to get a fair deal. So the point being, if you are your own central bank, no one can shut you off. And that's what it's all about.
Yeah. Yeah, powerful stuff. I'm glad we made that decision 30 years,
many years ago.
30 years ago.
And just one other thing on that subject. Think about this, and this goes to the coming central bank digital currencies. Under that system, if you go to the wrong website, if you say the wrong thing, support the wrong cause, who knows, vote for the wrong party or politician, they can just shut you off. They can say, well, no, you can't, or they can shut you off geographically. They can say, oh, well, you can spend your money, but you can only spend it within a 5 or 10 miles radius. So that's totally about control. Whereas holding gold, holding silver is about liberty. It's about you making your own choices and paying your own way.
Yeah. As always, Bill, you are you provide some wonderful information, and we like to think next time that we close the gap on these interviews and we get to speak with you within the next couple of months, in preference to leaving it to 4 or 5 or 6 months as it's been. But always incredibly valuable information.
So much common sense involved.
Basic.
And facts. Factual common sense.
Yep. Based on facts. Bill, a gentleman by the name of Charlie Jones, don't know if you know or remember Charlie Jones, is a pretty famous American motivational speaker. He used to say, in 5 years' time, you'll be in exactly the same position you're in right now, apart from 2 things: people you meet and the books you read. He had a massive library, and I learned a lot from listening to him, and we connected with a lot of people over the years that educated us and made us smarter people than what we otherwise would have been if we had not met them. The viewing audience today has that same opportunity. In fact, in connecting with Bill Holter through jsmindset.com, I just think it would be, it's just an outstanding opportunity to take advantage of that.
Absolutely.
Bill, could you just provide our viewers and subscribers, provide them with the means of making contact with you and what they may look forward to receiving in the process?
Sure. You can go to jsmindset.com. That's JSMINESET.com. We have a public side. We have a subscriber side. The public side, basically, where we post articles that we think are of interest, and we put comments with it. And then on the subscriber side, we do have some articles just for subscribers. We also do a weekly, roughly 1 hour call. There's 3 or 4 of us that are on the call each week, and that alone is worth the price of admission. Yeah. If you want to contact me on JS Mindset, you can go to contacts and it will get to me, or you can contact me directly. My email address is bholter@hotmail.com.
Wow. Couldn't get any better than that.
Well, look, it's just a fantastic opportunity. It's staring you in the face.
Yeah.
There is an opportunity. Take advantage of it. It's people like Bill Holter that make a difference to all of us in this world. Bill, thank you so much once again for your input and your support of this channel. It's very much appreciated. And we look forward to our next chat with you in the very foreseeable future. Until then, I'd like to thank also, never forgetting our subscribers. They are fantastic. They watch this show with absolute regularity. We appreciate your support. And so until next time, stay well, stay focused, and goodbye for now.
Goodbye for now.